This is the Commodities Trade Institute podcast. I'm your host, Emily Costa, and today is Monday, April 13th, 2026. We begin today in the oil market, where a dramatic escalation in geopolitics is once again reshaping the global energy landscape. The United States has announced a full maritime blockade of Iranian ports following the collapse of weekend negotiations, effectively raising the stakes in an already fragile ceasefire. This is not a symbolic move. It is a direct intervention into one of the most critical arteries of global energy trade. The Strait of Hormuz, through which roughly one-fifth of the world's oil flows, is now at the center of a high-risk standoff. While US forces have stated that transit to non-Iranian ports will not be impeded, the reality on the water is already telling a different story. Tankers are pulling back, shipping routes are being reconsidered in real time, and the market reaction has been swift. Crude prices surged above $100 per barrel in early trading, reflecting not just immediate supply concerns, but the broader uncertainty around how long this disruption could last. Even if flows are not physically blocked, the perception of risk alone is enough to tighten supply. Insurance costs rise, transit times lengthen, and suddenly the global oil system becomes less efficient. What's critical here is that this isn't just about Iran. This is about the pricing mechanism for oil itself. When a choke point like Hormuz becomes unstable, it injects volatility into every barrel traded globally. And that volatility is already feeding into inflation expectations, currency movements, and broader financial markets. But the ripple effects don't stop at oil. In agriculture, we're seeing a clear and immediate transmission of these energy shocks into food production. In Ukraine, farmers are now grappling with a sharp rise in input costs driven directly by higher fuel and fertilizer prices. Diesel, which is essential for planting and harvesting, has nearly doubled in price since the escalation began. This is forcing difficult decisions. Farmers are cutting planted acreage, delaying purchases, and in some cases reconsidering entire planting strategies. The expectation now is that production costs could rise by as much as 60%. If the situation persists. That's not a marginal shift, that's a structural shock. And it's not just Ukraine. In Colombia, extreme weather is compounding the pressure. Coffee production dropped nearly 30% year over year in March due to intense rainfall, with exports falling even more sharply. So at the same time that energy costs are rising, we're also seeing weather-related supply disruptions tightening agricultural markets further. This combination, higher input costs and lower output, is particularly dangerous. It creates a scenario where food prices rise, not because of demand strength, but because of constrained supply. And that has direct implications for global food security, especially in import-dependent regions. Now, shifting to metals, there's a quieter but equally important development underway. The United States and Australia have significantly expanded their financial commitment to critical minerals, pledging more than $3.5 billion to support new projects. This is part of a broader strategic push to diversify supply chains away from China, particularly for materials like rare earths, nickel, and other inputs essential for advanced manufacturing and energy transition technologies. What's notable here is the scale and the timing. These investments are not just about future demand, they're about geopolitical positioning. Control over critical minerals is increasingly seen as a lever of economic and national security. And by accelerating investment now, the US and its allies are trying to build resilience into supply chains that have long been concentrated. At the same time, infrastructure is expanding in Asia. New warehousing capacity for aluminum and lead has been approved in Hong Kong, reflecting continued growth in regional demand and the importance of logistics in metals pricing. Storage may seem like a technical detail, but in commodities it plays a crucial role in shaping market structure, influencing everything from contango to backwardation. Meanwhile, in carbon and power markets, a different kind of shift is taking place, one driven not by supply disruption, but by demand growth. The rise of artificial intelligence and data centers is dramatically increasing electricity consumption, and that is forcing a rethink of energy policy. In the United States, we're seeing a rollback of environmental regulations to keep coal-fired power plants online. The rationale is simple. The grid needs reliable baseload power to support this surge in demand. But the implications are complex. On one hand, this ensures energy availability and supports economic growth. On the other, it raises significant concerns about emissions and air quality. In some regions, particularly those already struggling with pollution, this could reverse years of progress. At the same time, there is growing momentum behind next-generation nuclear technologies. Major technology companies are now investing directly in small modular reactors, seeking to secure long-term, stable power supplies for their operations. This is a significant shift. For decades, nuclear development has been constrained by financing challenges and regulatory hurdles. But with large corporate buyers stepping in, the economics may begin to change. What we're witnessing is the emergence of a new energy paradigm, one where demand from digital infrastructure reshapes the entire power mix. And that has implications not just for carbon markets, but for every commodity tied to energy production. Finally, in dry freight and industrial supply chains, the impact of these disruptions is becoming increasingly visible. Ukraine's steel sector, already weakened by years of conflict, is now facing additional pressure from energy shortages. Production and exports have both declined, reflecting the broader challenges of operating in a constrained environment. Electricity disruptions are limiting output, while logistical challenges continue to hinder exports. And as with agriculture, this is not an isolated issue. Steel is a foundational material for construction and manufacturing, so any disruption here has downstream effects across multiple industries. Taken together, what we're seeing is a highly interconnected system under stress. A geopolitical shock in the Middle East is driving energy prices higher. That feeds into agriculture through fuel and fertilizer costs. It influences metals through investment flows and supply chain strategies. And it reshapes power markets through shifting demand dynamics. This is the nature of modern commodity markets. Nothing moves in isolation. Every disruption creates a cascade of effects that ripple across sectors and geographies. And right now, those ripples are becoming waves. As we move forward, the key question is not just how long these disruptions will last, but how they will reshape the structure of global trade. Will supply chains become more regionalized? Will energy markets become more volatile? Will food systems become more fragile? These are not short-term questions. They are structural shifts that will define the next phase of the global economy. And as always, we'll be here to help you make sense of it. If you found this episode valuable, be sure to subscribe, share, and leave a review. Find us online at commoditiesinstitute.com.